The global economy has been shaped by financial institutions, economic policies, and large corporations that operate across countries. Over time, different events and policies have made trade and business more connected worldwide. This chapter explains the role of international financial institutions, how the global market became integrated, and the characteristics of major corporations operating on a global scale. International financial institutions, or IFIs, help manage the global economy by providing financial support, setting trade rules, and guiding economic policies. Neubauer in 2011 highlights that these institutions, while promoting global economic stability, often operate under policies that benefit wealthier nations and multinational corporations, sometimes at the expense of local economies in developing countries. Critics argue that IFIs push neoliberal economic models that prioritize market liberalization over social protections. The International Monetary Fund, or IMF, was created in 1944 to help countries stabilize their economies, especially during financial crises. It provides short-term loans and advises governments on economic reforms. However, these loans often come with strict conditions, such as cutting government spending, which can make life harder for people in struggling economies. Many critics argue that the IMF mainly serves the interests of richer countries, as the most powerful nations have greater control over its decisions. The World Bank was also established in 1944 to help poorer countries grow their economies. It funds projects like building roads, schools, and hospitals, and offers loans at low interest rates. While its goal is to reduce poverty, some projects have been criticized for harming the environment or forcing people to leave their homes. Additionally, some countries have found themselves stuck in debt after borrowing from the World Bank. The World Trade Organization, or WTO, was founded in 1995 to make trade between countries easier and to resolve trade disputes. It encourages countries to remove barriers to trade, such as tariffs and import restrictions. While this benefits large corporations and wealthier nations, smaller and developing countries sometimes struggle to compete in an open market. Critics argue that the WTO prioritizes the interests of businesses over workers' rights and environmental protection. The Group of Seven, or G7, is a group of 7 wealthy countries, the United States, Canada, France, Germany, Italy, Japan, and the United Kingdom, that meet to discuss economic policies. The G7 influences global trade and financial regulations, but it has been criticized for making decisions that mostly benefit the richest countries, while leaving out major emerging economies like China and India. The global economy has changed significantly over the past century, becoming more interconnected due to major events and policy shifts. According to Neubauer in 2011, global market integration accelerated with the expansion of neoliberal policies that emphasize privatization and deregulation. He argues that these shifts, while boosting economic growth, have also deepened inequalities between developed and developing nations. After World War II, countries worked together to rebuild economies and avoid future conflicts. This led to the creation of the Bretton Woods system, which made the US dollar the main global currency and established the IMF and World Bank to help manage international finance. During this period, trade increased and multinational corporations expanded their businesses. However, in 1971, the system collapsed, and exchange rates began fluctuating, leading to financial instability. In the 1970s to 1990s, many countries adopted neoliberal economic policies that promoted free markets and less government intervention in business. Governments privatized industries, removed trade restrictions, and reduced regulations on corporations. The WTO, founded in 1995, strengthened free trade policies and further integrated the global economy. However, critics argue that these policies mainly benefited large corporations and wealthy nations while increasing inequality and environmental damage. The Asian financial crisis of 1997 was a major economic collapse that affected countries like Thailand, Indonesia, and South Korea. These nations had borrowed large amounts of money from international lenders, and when investors lost confidence, their economies crashed. The IMF stepped in with financial aid, but imposed strict conditions that led to economic hardship for many people. In response, some countries, such as China, introduced policies to control the flow of money and prevent similar crises in the future. Large businesses that operate in multiple countries play a major role in the global economy. These corporations take different forms depending on how they structure their operations. Multinational corporations, or MNCs, are companies that do business in several countries but still have a central headquarters in their home country. They often manufacture products in one country and sell them in others. By outsourcing production to countries with lower wages, they reduce costs and increase profits. Examples of MNCs include Toyota, Nestlé, and Coca-Cola, which operate worldwide while maintaining their main offices in their home nations. Transnational corporations, or TNCs, are similar to MNCs but have a more decentralized structure. They set up regional offices and factories in different parts of the world to adapt to local markets. These corporations focus on both global and local strategies, making their products more appealing to different cultures and economic conditions. Examples of TNCs include Unilever, Samsung, and IBM, which adjust their operations to fit the needs of each country they operate in.